If you were to design the perfect storm for investor anxiety, it would look remarkably like the landscape of 2026. We are living through a period of unprecedented dislocation. On one side of the ledger, we have a political environment in Washington that is as polarized as it is unpredictable. The return of Trumponomics, with its signature blend of aggressive tariffs, deregulation, and fiscal expansion, has rewritten the rulebook for global trade. Supply chains are being redrawn. Alliances are being tested. The national debt has breached levels that would have been considered mathematical fiction just a decade ago. On the other side of the ledger, we have the financial markets. Despite the geopolitical noise, the S&P 500 and the NASDAQ have spent much of the last 2 years defying gravity. Valuations in the technology sector, driven by the artificial intelligence narrative, have reached multiples that evoke uncomfortable memories of 1999 and 2021. The fear of missing out has infected the retail investor once again. The prevailing sentiment on Main Street is that we are entering a new golden age of American productivity. And yet, amidst this cacophony of optimism and political drama, the most successful capital allocator in history has quietly disengaged. Warren Buffett, the Oracle of Omaha, is not buying the narrative. More importantly, he is not buying the stocks. In a move that has baffled pundits and frustrated shareholders, Berkshire Hathaway has systematically liquidated tens of billions of dollars in equity positions. The sale of Apple shares, once considered a forever holding, was just the beginning. The trimming of Bank of America followed. As of the latest reporting, Berkshire's cash pile has swelled to over $325 billion. To put that number in perspective, Warren Buffett currently holds more dry powder than the entire market capitalization of McDonald's. He holds more cash than the GDP of Finland or Portugal. This is not a senile retreat. This is not a mistake. This is a calculated, high-stakes wager against the current consensus. While the world is betting on a soft landing and a political boom, Buffett is positioning himself for a liquidity event. For the serious investor, the individual with a 401k to protect, a family to provide for, and a retirement to fund, this divergence creates a critical dilemma. Who is right? The market, which says, buy everything, or the master, who says, sell into strength? In this documentary, we will look past the headlines. We will strip away the political rhetoric surrounding the Trump administration and focus purely on the capital mechanics. We will decode Buffett's 13 F filings to understand what he actually owns for this new era. And we will provide a blueprint for how you, the individual investor, can navigate the treacherous waters of 2026 without losing your fortune or your mind. To understand Buffett's strategy today, we must first dismantle the greatest fallacy in modern investing, the idea that the President of the United States controls the stock market. It is a seductive narrative. Humans are wired for storytelling, and the president versus the economy is a compelling story. We attribute every point gained on the Dow to the genius of the administration, and every point lost to its incompetence. But let us look at the cold, hard data. Since Warren Buffett took control of Berkshire Hathaway in 1965, he has invested through 14 presidencies. He has seen the Great Society spending of Lyndon B. Johnson, the stagflation and oil shocks under Nixon and Carter, the supply-side economics of Reagan, the budget surpluses of Clinton, the wars and financial crises under Bush, the quantitative easing under Obama, the trade wars of the first Trump term, the inflation of the Biden years. Through this entire 60-year period, a period of assassinations, resignations, wars, and impeachments, the compounded annual gain of Berkshire Hathaway was roughly 19.8% compared to 10.2% for the S&P 500. If Buffett had adopted a strategy of political timing, selling stocks when a Democrat won or buying only when a Republican won, his returns would have been decimated. In his 1994 letter to shareholders, Buffett wrote a sentence that should be tattooed on the desk of every investor. We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. Why? Because macro politics is rarely actionable. Consider the 2016 election. The consensus on Wall Street was that a Trump victory would crash the markets due to uncertainty. Instead, the market rallied. Consider the 2022 midterms. The expectation of a red wave was supposed to gridlock Congress and boost stocks. The wave didn't happen, yet the market eventually found its footing. In 2026, the narrative is that Trumponomics 2.0 means lower taxes and higher profits. On the surface, this is bullish. But the second-order effects, higher tariffs leading to higher input costs, potential retaliatory measures from trading partners, and a ballooning deficit, are deflationary for valuation multiples. Buffett understands this nuance. He knows that a tax cut is good for earnings per share, but a trade war is bad for the discount rate. He doesn't bet on the outcome of the policy. He bets on the resilience of the business model. He is not asking, what will Trump do to China? He is asking, does Apple have enough pricing power to pass the cost of tariffs onto the consumer without losing market share? The fact that he sold a significant portion of Apple suggests that, at current valuations, he is no longer certain the answer justifies the risk. This is not a political statement. It is a mathematical one. If Buffett is selling the high-flying tech darlings of the last decade, what is he keeping? What does a Buffett portfolio look like for the volatility of the late 2000s? By analyzing the latest SEC filings, we can see he is constructing a portfolio designed to survive three specific threats: inflation, geopolitical fragmentation, and valuation compression. Let's break down the core components. First, the energy hedge, Occidental Petroleum and Chevron. This is perhaps the most explicit alignment with the Trump-era reality. Buffett has poured billions into the energy sector. Why? First, energy is the only sector that acts as a genuine hedge against geopolitical chaos. If a war breaks out in the Middle East, or if supply chains rupture, oil prices spike. Most stocks fall in that scenario. Energy stocks rise. It is portfolio insurance. Second, the Trump administration's focus on deregulation and energy dominance directly benefits the bottom line of U.S.-based producers. Occidental Petroleum, with its massive footprint in the Permian Basin, is a direct beneficiary of domestic drilling policies. Buffett is effectively saying, I don't know if we will have a green transition in 20 years, but I know we will need oil for the next 5 years. He is buying the cash flow of the present, not the dreams of the future. Second, the financial fortress, insurance. While he sold some banking stocks, Buffett has doubled down on his core insurance businesses like Geico, General Ray, and Allegheny. Insurance is a beautiful business in a high-interest rate environment. Insurance companies collect premiums up front, the float, and pay claims later. In the interim, they invest that money. When interest rates were near zero, that float earned nothing. Today, with rates hovering around 4 or 5%, Berkshire's float is generating billions of dollars in free income, risk-free. This is a defensive play. People pay their car insurance premiums whether the economy is booming or crashing. It is a non-cyclical cash stream that funds his other bets. Third, the Japanese conglomerates. One of Buffett's most brilliant moves of the 2000s was his investment in the 5 major Japanese trading houses. This is a play on commodities and hard assets. These companies deal in everything from metals and energy to food and textiles. They are the plumbing of the global economy. In a world of deglobalization and tariffs, a core theme of the current U.S. administration, owning the intermediaries who control the physical flow of goods is incredibly valuable. These stocks were cheap, they pay high dividends, and they provide diversification away from the overvalued U.S. dollar. Notice what is missing from this list: No speculative AI startups. No unprofitable SaaS companies. No crypto. Buffett is buying real assets, real cash flow, and real moats. He is buying things that you can drop on your foot. In an age of digital hype, he is betting on the physical world. Now we arrive at the most contentious part of the analysis: the cash. Critics argue that holding $325 billion in cash is lazy or inefficient. They say Buffett has lost his touch. They point to the S&P 500 hitting new highs and say, "Look what he is missing." But let us reframe the situation. Buffett is not holding cash because he loves inflation. He is holding cash because he views it as a call option on liquidity. In financial markets, liquidity is like oxygen. You don't notice it when it's there. But when it disappears, it's the only thing that matters. We have seen liquidity crises before: 1974, 1987, 2000, 2008, 2020. They happen when everyone is on one side of the boat. Right now, everyone is on the long tech side of the boat. Buffett knows that the Trump rally or the AI boom can turn into a liquidation event very quickly. If inflation spikes again, a real risk with tariffs and deficits, the Federal Reserve will have to keep rates high or even raise them. High rates break things. Commercial real estate is wobbling. Regional banks are fragile. The U.S. government's interest expense is skyrocketing. If something breaks, who has the money to fix it? Not the banks. They will be hoarding capital. Not the government. They are drowning in debt. Berkshire Hathaway has the money. Buffett is positioning himself to be the buyer of last resort. In 2008, during the darkest days of the global financial crisis, Buffett lent $5 billion to Goldman Sachs and $3 billion to General Electric. He got terms that were practically predatory: 10% dividends and warrants to buy stock at rock-bottom prices. He made billions on those deals. He can only do that because he had the cash when nobody else did. By holding $325 billion today, Buffett is essentially saying, "I believe the market is fragile. I believe a better pitch is coming, and when it comes, I want to swing with a baseball bat, not a toothpick." It is a lesson in delayed gratification. While the rest of the world is chasing 15% gains in Nvidia, Buffett is waiting for the opportunity to make 500% gains on the entire distressed market. So what does this mean for you? You are not Warren Buffett. You don't have special access to deal flow. You can't wait 5 years for a crash without growing your retirement account. However, you can adapt the Berkshire 2026 framework to your own personal finance strategy. Here are the 3 pillars for the prudent investor in this political and economic climate. Step 1. Reevaluate your risk-free allocation. For the last 15 years, there was no alternative to stocks because cash paid 0%. That is no longer true. Short-term U.S. Treasuries and high-yield savings accounts are paying 4 to 5%. If you are 55 or 60 years old, do you need to be 100% in equities? Buffett has nearly 30% of Berkshire's market cap in cash. Consider building a larger dry powder fund. This serves 2 purposes. It gives you guaranteed income now, and it gives you the psychological strength to buy stocks if the market crashes later. Step 2. Audit your portfolio for pricing power. The biggest risk in the Trump/inflation era is margin compression. If tariffs make raw materials more expensive, who eats that cost? Look at the companies you own. Weak pricing power exists in airlines, commodity hardware, and generic retail. Avoid these. Strong pricing power exists in luxury goods, essential software, dominant consumer staples, and top-tier healthcare. Buffett keeps stocks like American Express because they can pass costs to customers. Ensure your portfolio is tilted toward quality, not just growth. Step 3. Disconnect your politics from your portfolio. This is the hardest step. If you love Trump, don't borrow money to buy stocks because you think we're going to the moon. If you hate Trump, Don't sell everything and go to cash because you think he will ruin the country. The market is a mechanism for discounting future cash flows, not a voting booth. The investors who made the most money over the last 50 years are the ones who stayed invested through Nixon, through Clinton, through Obama, and through Trump. Your political feelings are valid, but they have no place in your brokerage account. History will likely look back at 2026 as a pivot point, a time when the easy money of the post-COVID era ended and a harder, more volatile reality set in. Warren Buffett, at 95+ years old, has seen this movie before. He knows how it ends. He knows that euphoria is always followed by despair. He knows that debt eventually matters. And he knows that the patient investor always collects the impatience tax from the speculator. He is sitting in Omaha, reading his newspapers, drinking his cherry Coke, and watching his mountain of cash grow by millions of dollars every single day just from interest. He is in no rush. The question is, are you? In a world addicted to speed, Buffett's ultimate edge is his slowness. In a world addicted to noise, his edge is silence. You don't need $325 billion to apply that lesson. You just need the discipline to stop reacting to the headlines and start respecting the fundamentals. Because while presidents get 4-year terms, your wealth has to last a lifetime. Invest accordingly.